Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk about pensions. In fact, I want to start a little series on pensions, and I realize not everybody has one, but also I realize that those people who do are sometimes in need of guidance with them just because they aren't as widespread today. Some people don't have the range of advisors who are familiar with those types of products. Now, having said that, I want to put the immediate caveat that I cannot advise you specifically. My goal is to provide you with certain information in a general way for entertainment purposes and have you just kind of get the wheels turning in terms of thinking about your pension. But if you need specific advice, you're going to want to consult with a financial advisor or somebody knowledgeable in your area. With your company, if your company offers a pension, then you most likely have some kind of a human resource person or some kind of a retirement plan person that you can talk to about the specifics of your plan, and I would invite you to do so. But let me start with a Google definition. Google definition of pension runs like this. It says that it is a regular payment made during a person's retirement from an investment fund to which that person or their employer has contributed during their working life. This definition has 4 parts, and I want to make this video basically simply follow those 4 parts and talk through a little bit about what each one implies and what each one means specifically. So looking at the first part of it, it says that a pension is a regular payment. Well, the first thing that you should realize is the word regular here basically means rule following. Etymologically speaking, the word regular has to do with rule following or being rule bound. So what do we mean? We mean that there are rules. There are rules for how to calculate the pension amount. It's not just sort of willy-nilly. There are going to be specifics, and this would be in your employment agreement. It would be in your retirement plan particulars. And so that's where a conversation with your retirement representative is going to be extraordinarily helpful. But it's going to be rules that govern how much you're qualified to receive, when you're eligible to take payments. Usually there's going to be there are going to be rules concerning when you can take the money, how long you have to work for the company, and other things like this. One of these rules is called the Rule of 85, oftentimes, and I did another video specifically on the Rule of 85, and I would invite you to consult that one if you want a little more information on how some of these rules can apply. But for the time being, let's just say that the rules are going to make the amount of your pension payment predictable, and they're going to govern the size of that payment and when you're able to take it. Number 2, they're payments that are made to you in retirement. Now this seems obvious for most people because we're talking about pensions and just the word pension usually implies retirement, but it's worth pointing out that not all regular payments, which was the first part of the definition, do have to be in retirement. Some are not. So for example, if a person's disabled, their disability income payment might be at any time during their working life. It may, in fact, for a disability payment, it probably is well before their retirement. And whether that's private disability or whether that's SSDI or Social Security disability, their check is not going to have to wait for retirement. Or again, a life insurance proceed can be paid out to beneficiaries regardless of how old they are. Lottery winnings, same thing. Same thing with a trust payout. If you've got a trust fund or something like that paid to you or to a family member, that doesn't have to wait for retirement. It might be for retirement, but it might not be. So pension payments are regular payments paid to you during retirement. So when is retirement? And I've talked in another video, yet again, about the different conceptions of retirement. So on one conception, retirement is just whenever you stop going to your 9 to 5. Well, if you stop going to your 9 to 5 at the age of 45 because you've amassed enough money to where you don't have to work, you might not be eligible for a pension even if you qualify for it in terms of years of service. And the reason is, at the age of 45, you might not be old enough to count as retired under a non-loose definition. So sometimes there are specific definitions for retirement that include reference to a particular age. That age commonly would be something like 59 and a half, but it could be anything. It could be 62, 65, 66, 70, 72. These are ages that crop up in retirement conversations, and so for most conversations about retirement, the retirement age is 59 and a half. But you need to consult with the particulars of your retirement plan in order to know for sure what, if any, age applies to your pension. Now, the third part of the definition after regular payment made during retirement was from an investment fund, number 3. Now, the first thing I'll say about this is the word investment has at least 2 senses. In a general sense, to invest is simply to put your money into something. So if you put money into a savings account, on this general definition, you have invested your money in a savings account. The opposite of investing would be divesting or pulling your money out of something. But in a specific sense, Investment doesn't just mean to put your money into anything. So, for example, we don't think of it as investing in a savings account. And so, in the specific sense of investment, we mean generally to put your money into something in particular, and that would be things like stocks and bonds. So, finance has different, let's call them sectors. Banking sector, where you'll have certificates of deposit or CDs, money market savings accounts. You've got an insurance sector where you have annuities and life insurance contracts, but you also have the investment sector. And this is going to include things like brokerage funds, mutual funds, where people invest in equities, in securities, and other things that, again, are commonly referred to as stocks and bonds. But in fact, there are far more options than that. There's derivatives markets and very high level stuff. Now, a fund in this sense is reference to a group of people who pool their money together for investment purposes and also who spread risk around amongst themselves. Some examples of funds of this type would include ETFs or exchange traded funds, mutual funds, probably the most common, also hedge funds, many other funds that are arranged in this way. So why are investment funds more common for pensions to be in rather than in CDs or something? And the answer is because those investment funds promise greater returns. So the idea is the employer or somebody else is going to put in money, and you want there to be more money in that account when it comes time to start taking payments from it, if possible. And so the sector of the economy that has, in popular imagination anyway, then the sector for making money is the investment sector, stocks and bonds. But the second reason that pension plans are often part of the investment sector is because historically the pension has been the third part of a three-legged stool conception of a person's retirement. So the first part of that conception was the part provided by the government, so government funding in the form of Social Security. The second leg of the stool was your personal retirement savings, things like now 401k, 403b, 457b. The third leg of that stool historically was the employer pension program. And so with other things in place, with the Social Security in place, with your private savings, you could apportion your risk a little bit differently than if you were just counting on one. If you have multiple different things that are going into your retirement plan, that's going to change the way you approach risk. And with a pension plan, that meant that since the pension plan was part of an overall picture, and since the markets were doing a little bit better at the times when pensions were more popular, pensions were often invested in the market. But this talk of the three-legged stool transitions us into the fourth and final part of that definition, which was who pays. So remember, in that definition from Google, we said that the pension is a regular payment made during a person's retirement from an investment fund, and then the fourth part was to which that person or their employer has contributed during their working life. The first thing I want to say is the word or there is, in a logical sense, an inclusive or. And I'll bet you never thought that your college logic class was going to matter to you, but the inclusive or is a statement where either of the two disjuncts can be true in order for that whole disjunction to be true. So if we say you or your employer, that statement is true if you contributed, if your employer contributed, or if you and your employer contributed together. And I don't want to spend a whole lot of time on the fact of who contributed, because in most cases, when people think of a pension plan, they think of their employer making contributions on their behalf. But let me put it this way. When we think about retirement planning, we're basically talking about money you set aside now for your retirement later. There are three relevant phases. The money you pay in, called a contribution, then the money sits there and it either grows or it loses money, hopefully it grows, and then the third phase is the distribution phase or the benefit phase where you take the money out. So you put the money in, something happens to the money, and then you take it out. And those are the three phases of money that is designed for your retirement. Now, if the money that goes in is called a contribution, and the money that comes out is called the benefit or the distribution, then we can ask the question, which of those two things is guaranteed? Now, in some cases, none of it is guaranteed. And if we want to really press the matter, really nothing is guaranteed, because no matter what, the market could completely collapse tomorrow, in theory, and a person who has a retirement account might have nothing despite whatever guarantees there might be. But in general, when we talk about guarantees, we're talking about which of the two things the company is prepared to put in writing. And so we talk about a defined contribution plan and a defined benefit plan. And defined here basically means that there are parameters around it that amount to guarantees. So if a company has a defined contribution plan, That means that they're guaranteeing the money that they put in to the plan on your behalf for your retirement. So that, for example, would be found in a matching 401k program. A matching 401k is a defined contribution plan because the company is guaranteeing the amount that it will put in if you put something in too. So usually that's the way it works. If you put in 5%, maybe your company guarantees you that it will put in 2.5%. That's just making the numbers up. That's a defined contribution plan. But on the other hand, companies in the past didn't guarantee what they would put in so much as they guaranteed what you'd be able to take out in your retirement. So a defined benefit plan was one where an employer might say to you, look, if you're making $100,000, we will guarantee you 85% of that, making the numbers up, in your retirement. So if you made $100,000 and your defined benefit pension plan guaranteed you 85%, you knew that you were going to get $85,000 a year if you made it to your retirement. So usually the requirements on that were certain amount of service, maybe 25 years of service, certain level of income, right? So you had to make 100,000, 25 years, they'd guarantee you 85%. Now obviously I'm abstracting away from a lot of stuff. Over 25 years of employment history, your salary is probably going to have gone up over time, maybe it went down some years. You get the picture. The basic point is that there are defined contribution plans where the risk is on you in terms of how much you're eventually going to get. The employer simply guarantees how much it's going to put in. So in a 401k, if your investments don't pan out, too bad, so sad for you at the end. But in a defined benefit plan, the company is basically guaranteeing you, we will make sure you have this amount of money. So if the investments don't pan out, that's on the company. Now, this is one reason why companies have started to not offer pension plans anymore. In the year 1998, 59% of Fortune 500 companies offered pension plans. In 2017, only 16% of Fortune 500 companies offered pension plans. That's an extraordinary decline, and one of the reasons for that decline, again, is where the risk is. The risk is on the company. The companies are opting to divest themselves of that risk, put it onto the employee, put it onto you, and so fewer and fewer companies are offering pension plans. Government pensions are still a thing, but private sector pensions are going the way of the dinosaur. Now, the final thing I'll mention about pensions in this video is going to be this, and that is even companies that have a pension, those pensions are not necessarily unassailable. So think here about Kodak. Eastman Kodak had a pension and then it was in jeopardy. General Electric, same thing. Peabody Coal was part of a very famous or infamous case where the pension program was in deep trouble. Sears is another one. My dad worked for Sears for 45 years. When he started, they had a pension. Just a couple of years ago, they didn't have a pension, and now Sears is bankrupt and not in any of the major indices. The fact of the matter is that even people who had pensions, they might be pensions from religious programs, or you can even think about public retirement systems. Those pension programs are in very deep trouble in some states. So there are some questions about whether or not even the pensions that are around now will be around for your retirement or through the retirement, even if you have them. So that's something to keep your eye on. A couple of reasons that are given for why pensions can fail. Number one might be the bankruptcy of the company that is either the sponsoring company or the holding company for the pension program. Mismanagement, which is often thrown out there. But another one would be poor investment returns or losses that were not anticipated. The markets could end up doing worse than people thought when they put the money in, and that can leave less for retirees. But a fourth reason, and one that kind of encompasses all of the other three, are going to be the intervention of people called private equity managers. Now for this, I'm going to defer to people like Max Kaiser, who was a Wall Street trader who's very critical of these private equity firms. And basically they do leveraged buyouts on companies. They saddle those companies with debt, and often the pensioners are the ones that suffer the greatest loss. If you have a pension, I certainly hope you can keep it. In future videos, I'm going to get into things that might be of interest to people who are about to elect pension. So for example, there's something called a pension maximization plan or a pension max. I'm going to talk about pension optimization, which is a similar but somewhat differentiatable concept. If you have specific questions that you need to run past an advisor, I invite you to find an advisor in your area who's knowledgeable about your situation. But if you found something of use in this video, I do ask you like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in one of the future installments. Thank you so much.